is really impressive. That actually tells, if you want to put that in bigger words, as any social scientist would use, is globalization, at least economic, so real globalization, not financial, has not been affected so far. And this is great news for Asia. This is great news for any open economy. And this is actually what's making the difference today. We knew that India was growing, that China was growing. But what we didn't know only a few months ago is that Taiwan would boom, Singapore would boom, Hong Kong would boom, simply because trade is back. I think this is really a key message that I'd like to convey to you. And trade is back not because we're wrong with the numbers, not because even if I show you that Europe is stagnant, they're still importing lots of your manufacturing products. No, it's because the emerging world is bigger than we had expected. It's because Brazilians are importing from China. It's because Mexicans are importing from China, and many others. So if you see at the contribution of trade growth from the advanced world and the emerging world, you see in the fourth quarter of 2009 that the emerging world is already like explains two-thirds of that growth. Those are the importers today. So you want to be well located in this area of the world. So again, I think let's not forget that we are on the main scenario. And the main scenario, no matter how many risks we want to put on the table, is better than 3 months ago. Now, are there risks? Yes, the risks are enormous. And probably the risks are increasing. And we're moving more and more into a very volatile world where the main scenario may be X, the risks are higher and higher, and maybe sometimes even in very different directions. So for the advanced economies, I'm afraid they all go in a very similar direction, which is downward. Those are the risks. For the US economy, having learned a lot from Bill's presentation, I still think there are a few risks out there. First is, as I said, how to undo the fiscal stimulus without harming the economy, no doubt. But the other one that has not been mentioned, or maybe it has, but I've kind of lost it, is this creditless recovery. Bank credit is not recovering, either in the US or Europe. Is that good? Well, I'm not sure, but what we know, we economists, again, with our linear models, is credit is crucial for growth. For Europe, the risk lies on the other side at this point in time is, well, we've already realized we need to cut down on the fiscal stimulus. However, it might be too late. Markets are already, asking for a lot of that, and it's very hard to carry out at that speed that the markets are requesting. For emerging markets, as I mentioned, the risk until now was there's really too much growth here. There's really too much happening. We've heard there's no inflationary pressures. Well, our view is there aren't so far, but the exit strategies from this fiscal and monetary stimulus, especially in Asia, are just too slow. And I'll show you a little bit of evidence about that. And the other risk comes from contagion, as I mentioned, the risk of too little. So on the risk of too much, on the overheating, this is similar to what has been presented before. This graph that might look kind of awkward for non-economists, it shows, on the vertical side, the output gap. How far are countries from their potential output, what they should be producing given their endowments and their supplies. And on the horizontal side, you have how accommodative, how lax monetary policy is. So, if you move leftwards and upwards, you should be worried because you're not yet dragging out of the economy in the liquidity that is in excess. If you have a big output gap, so you are on the lower side of the graph, even if your policy is accommodative, you could say, okay, not yet time for me to increase rates. But you look at the countries that really stand out, those are India and China. So it's very clear that they should have, India has, but not to the extent that would have been required, they should have been moving rates or credit targets, or you name it, sooner than they have. That's really the key message here. They are not really controlling this fast growth, not so far. And most countries are Asian there. The exception would be Brazil, as you find, but it's still, the monetary policy is less accommodative than anywhere else in Asia. So that's really the risk of too much that we see, that inflation, and we're seeing that in Brazil already. It's really close to the target, and it's going to be very difficult to control inflation in Brazil. I could talk more about Asia, but I think that we'll hear so much more that I don't want to make it too boring for you. The other thing is, as you show that you're so nice, as Asia or Brazil or these very fun countries today, money keeps on creeping in. You may have controls still, controls we all know. Controls are there. They may avoid further appreciation, but they won't avoid it all. And this is much more the case for countries without controls, or hardly any controls, such as in Latin America. So what you see in these graphs is that capital inflows are back to an extent that is comparable to right before the crisis in 2007. So they are huge. And we already have an average appreciation of emerging markets currencies above what you had in 2007. It's about 24% on average. That's really a lot. And we are seeing that, building up reserves. Even Argentina is building up reserves. I mean, it's kind of, how can that ever happen? I mean, they are restructuring the debt. They stopped paying 2001, and they're building reserves. Isn't there something like that just doesn't add up? Because for economists, everything adds up as long as you can put it in a graph, But I'm sure if we had a social science here, they would say, this doesn't make sense. It's just too much inflows, too much growth. And you see it here. We just had a map of risk. We built up output gap, domestic demand, inflation, credit, asset bubbles. And we had a list of countries, emerging countries everywhere in the world. This is a lot of information, but we help you out with the colors. Reddish sounds like danger, doesn't it? So you have there countries such as China, India, Indonesia. Those look redder than anywhere else. So they're in a great situation, just that probably too much of that. Now maybe Europe will come to the rescue. Maybe it would be great to have sovereign risk up in the sky, and people getting very worried and just saying, please slow down. And capital inflows may be going to cash, or, that might have other consequences. But the truth is that there are countries in the emerging world that would not look different than Spain. Maybe not Greece. In that sense, I tend to disagree with Luca, because Greece is really an outlier. Look at that. Public debt runs, at about 120% of GDP, and the fiscal deficit is 14% of GDP. There's no country that, looks as dangerous as Greece at the moment. But never mind. They got lots of money, so I guess they'll figure it out. But you have countries there in the emerging world, such as Hungary, Turkey, India, Ukraine, Romania, Russia, that would look worse than Portugal or Spain in terms of this very simple metric, public debt and fiscal deficit, which is the metric markets are concentrated on. I mean, markets are not looking at hundreds of variables at the same time, as we all know. So I'm just saying that if things turn for this risk of too little and contagion actually occurs, there are countries out there they could focus on, no doubt. They will always find some. So that's where this very nice thing of having Europe having trouble and maybe less of an overheating in Asia and some countries in Latin America might turn sore for some of those countries. Maybe not the same, but some others. So again, very important for anybody doing any business anywhere in the world is watch out countries are not the same. Anywhere, even in the emerging world, which now packaged